Hey guys, it is Jimmy with Swiss Realty here, and we are back with another video. And in today's video, we are going to go over the question I've gotten many times. It is, can you offset your W-2 income by buying a short-term rental? And this video, I'm going to be honest with you guys, this video is going to be one of the most important videos I've ever dropped. The reason why is because this video, if you apply everything that you hear in this video and you actually apply it, you can save yourself hundreds of thousands of dollars every year. And I genuinely mean it when I say that, and I am not, BSing you guys in any way. And I'm going to give you the guys the whole breakdown on how this is possible. So without any further ado, I would love to introduce myself. My name is Jimmy with Swiss Realty here. I help investors find their next buy and hold, BRRRR, flip, short-term, mid-term rental here in the Columbus, Ohio market. I've done well over 25 million in real estate sales. I've helped clients from all across the world, all across the US, help them buy rental properties here in Columbus, Ohio, and help them essentially build financial freedom. So with that being said, let's definitely jump into this video. But yes, to answer your question, can you offset W-2 income by buying a short-term rental? 100%. And I'm going to tell you exactly how that is possible. The first thing I want to clarify before we jump deeper into this video is when it comes to long-term rentals, so LTRs, that is passive investing. The reason why is because when it comes to long-term rentals, you're not proactively, managing it. Like, it is essentially you just collecting a check and that's pretty much it. So because of that, the IRS does classify long-term rentals as passive investing. So because of that, if you do not have rep status or real estate professional status, your deductions will be limited to your income. And if it's up to 150K, if you make more than 150K, you cannot offset your rental income at all, essentially, if you don't have rep status, of course. And the max limit, essentially, if you don't have rep status, it is $25,000. So as you can see, it's not a great option for offsetting your W-2 income when it comes to, long-term rentals, because number one, you are capped off by, how much income you make, which is 150K, which, it's not that crazy high. And on top of that, you only get $25,000 in deductions, which again, it's not that high as well too. But if you have a short-term rental, I will let you know this. And again, this is what the IRS classifies it. It can be classified as a non-passive investment. So the most important thing is it does have to be rented at an average of 7 days or less per stay, and you have to materially participate, which we're going to get into very shortly in this video. And then if you do both those things where your average stay is less than 7 days, and on top of that, you do materially participate in, the short-term rental, your losses are fully deductible against W-2 income. Even if you make $500, $1 million, there is absolutely no limit at all. And the best thing is you do not need real estate professional status. And also, I keep saying this word, real estate professional status. So long story short, just to give you guys the quick 30-second answer, when it comes to getting rep status or real estate professional status on your taxes, that is something that's very, a lot of people really want. The reason why is because if you have that status, you can depreciate or deduct all of your real estate losses against your W-2 income or the rest of your income, all your income aside from real estate as well too. It's fully deductible, and that is very desired. And when it comes to this strategy that we're talking about, you do not need a rep status. Okay, so anyone could do this. To get rep status the traditional way, you will typically need 750 hours of real estate work, which is, for a lot of people, that's a lot. That's a whole job right there. So a lot of people aren't able to qualify for rep status, obviously, if they're not a realtor, contractor, stuff like that. So because of that, what I will say is, again, you don't need rep status. And by not having rep status, anyone can do this, okay? So yes, high income earners, they can use short-term rentals to wipe out a huge chunk of the taxes if they play by the rules. So let's definitely dive deeper into that. First thing I want to let you know is, number one, it must be a short-term rental and your average stay must be 7 days or longer. It cannot be a midterm rental, which again, midterm rentals, typically they are at least, 30 days in this case, 30 to, a few months to half a year. stuff like that will not apply, unfortunately. Also, same with long-term rentals, which obviously they are on an annual lease. Typically, they're definitely not gonna apply in this case. So it will have to be a short-term rental. There's no work around this. Okay, it must be a short-term rental, and your average stay must be 7 days or less. Okay, so that's the first requirement. Second requirement is to materially participate in the short-term rental and to use this tax hole. You will need to meet at least one of these IRS tests, okay? And here are some of the most common ways that people have qualified. Is number one, is that option one, it's the 100-hour rule. So you spend over 100 plus hours working on the property, and no one else, even a cleaner, manager, no one else spends more time than you. This is the most common route when it comes to short-term rental investors. By far, most investors kind of go this route, but you will have to spend obviously some time when it comes to working on the property, and obviously you will need to document this stuff. You will need evidence, that documentation that, again, you have worked 100 plus real estate hours when it comes to this property and when it comes to short-term rental. Second thing is the 500-hour rule. So this means that you personally have worked over 500 plus hours on the short-term rental during the year, and it also doesn't matter how much time others have spent in this case. Okay, so this is really good if you are very hands-on, or you have multiple short-term rentals, or you're just working a bunch and you're very hands-on. This is the route to go. But again, I will say the easier route is probably the 100 plus hour option in my opinion. But again, there's multiple ways to qualify. And the third route is doing most of the work. So you substantially do all of the work yourself. Essentially, you're the one managing it, cleaning it, handling everything. Then obviously you will qualify for this short-term rental loophole in this case. So these are the three options for qualifying for this loophole. And again, I would say option one, this is the one that most people go with in this case. So just to recap off really fast. So I will let you know, when it comes to long-term rentals, you will need rep status to offset your W-2 income if you really want, huge deductions, and to really, really lower your W-2 income, you will want rep status, which is again 750 plus hours of real estate related activities. That's a lot for some people. And if you do not have rep status, then there is a max income limit of 100 to 150K and a max limit of $25,000 in passive losses that you can deduct. Okay, that's the first thing. And the second thing is short-term rentals, which there is no real estate professional status needed. So again, you do not need to work 750 hours of real estate related activities, as long as you materially participate, which again is kind of what I mentioned right here, the 100-hour rule, the 500-hour rule, and or you doing most of the work yourself. As long as you materially participate, and your property is a short-term rental, and the average stay is 7 days or less in this case, then you have no income limit and no loss limit when it comes to deducting your losses when it comes to your short-term rental with your W-2 income in this situation. And one very, very strong combination that I would say most of my clients do is they will buy a short-term rental. They will essentially, again, materially participate in it, make sure that they can qualify for deducting all these losses, and then they will also do a cost segregation, which that's a whole other video. We're not going to dive into it in this video, but if they do a cost segregation, they can get huge deductions. The reason why is because I'm sure you guys have heard of 27 and a half years for straight line depreciation. So when you do a cost segregation, you do not depreciate the house over 27 and a half years. Instead, you can depreciate it as quick as 1 year, 3 years, 5 years. It's on a much more accelerated timeline. So because of that, instead of, again, getting depreciation for 27 and a half years, you can get it, shortened to 3-5 years in this case, and you will get much larger deductions, obviously all at once and all in the beginning. One thing I do want to let you know is when it comes to cost segregations, if you do sell your property at a later time, you will have to pay back those losses that you've depreciated. But if you are looking to offset a huge amount of W-2 income, 100% that is the way to go. So with that being said, that is the recap of this video. Again, I've worked with dozens of clients doing this exact same strategy, so I am very familiar with it. If this is something you want to learn more about, definitely hit me up. I would love to kind of help you out if that is something you're looking to do. If you're have any questions, definitely DM me. Make sure to comment in this video. Happy to help with whatever that comes up. But aside from that, my name is Jimmy with Swiss Realty. I help investors find the next buy and hold, BRRRR, flip, or short-term, mid-term rental here in the Columbus, Ohio market. I've been doing this, again, for a very long time. So if you have any questions, hit me up. We'd love to answer them for you guys. Thank you so much. Really appreciate it. See ya. Bye.